Stop. If you've ever placed a trade because it felt right, you've already been in danger. You know the moment. Your heart speeds up. Your gut says, this is the one. And somehow those are the trades that hurt the most. Here's the uncomfortable truth. The stronger the feeling, the worse your edge usually is. Most traders think confidence means opportunity. It doesn't. Often, it's a warning signal your brain is about to sabotage your account. In the next few minutes, you'll learn how to spot the exact emotional trap that destroys profitable traders, and the simple shift that keeps you out of it. Miss this, and your feelings will keep picking your losing trades. You've felt this before. That quiet pull in your gut when the market starts moving. The tape begins to tick faster, the candles stretch. And something inside you whispers now, this is the moment. I've known that feeling. Every trader who has lasted more than a season has known it. But let me tell you something plainly, the way the market taught it to me: when a trade feels urgent, it is usually dangerous. You see, the market does not pay you for being excited. It does not reward courage for its own sake. It pays only for being right, and being right at the right time. How many times have you watched a chart, felt that surge of certainty, and jumped in, only to see the price turn the other way? Be honest with yourself. It happens more often than most care to admit. The trouble is not the market. The trouble is the human element. Your feelings are built for survival in the wild, not for survival in speculation. The same instinct that tells you to run from danger or chase opportunity is the one that gets traders into trouble. When the price runs quickly, your pulse follows it. When the crowd grows loud, your judgment grows quiet. Have you noticed that? In my day, we read the tape. Today you read charts. But the principle hasn't changed by a single tick. The market moves on supply and demand, not on how strongly you feel about a setup. A chart does not care about your hopes. A trend does not bend for your confidence. The only thing that matters is whether the conditions are truly in your favor. Most beginners believe their problem is knowledge. They think if they learn one more pattern, one more indicator, one more clever trick, the money will come. But the market has a way of humbling that kind of thinking, because the real enemy is not ignorance. It is impatience dressed up as conviction. Tell me, have you ever entered early because you didn't want to miss the move? That right there is the feeling I'm talking about. The market has a peculiar habit. The more a trade feels like you must take it immediately, the more likely it is that you are being pulled by emotion instead of evidence. Professionals learn to distrust that urgency. Amateurs chase it. Now, don't misunderstand me. I am not saying you should trade without instinct. Experience builds a kind of market sense, yes, but that sense is quiet. It is patient. It does not pound on your chest demanding action. When you truly see a proper setup, one that aligns with the trend, the structure, the volume, it feels almost boring. Did you know that? The big money is rarely made in moments of excitement. It is made in moments of clarity. When I made my best trades, I was not trembling with anticipation. I was calm. The market had already shown its hand. All I had to do was wait for the proper point and place my bet. That is a very different state of mind from the fever most traders operate in. You must learn to separate the two. Look at your charts carefully. When price makes a sharp, emotional move, wide candles, sudden spikes, what usually follows? More often than not, you get a pause, a pullback, or a shakeout. Yet, what do most traders do in that moment? They feel the move slipping away and they jump in late. The market feeds on that behavior. The crowd buys excitement. The professional buys structure. There is also the matter of money management, which too many treat as an afterthought. Feelings grow louder when your position size is too large. Ever notice how calm you are with a small position and how emotional you become when the size is heavy? That is no accident. Oversized positions amplify fear and greed until good judgment cannot breathe. A trader who cannot control size cannot control emotion. An emotion, left unchecked, will lead you to do the very things that destroy accounts, cutting winners short, letting losers grow, chasing breakouts that are already extended, and abandoning sound plans the moment pressure appears. The market has no mercy for that kind of behavior. Never has. Never will. You must build a different habit. Before every trade, ask yourself a simple question. Am I acting on evidence or on feeling? That question alone can save you a great deal of money over the years, because evidence is visible on the chart, in trend direction, support and resistance, volume behavior, and market context. Feelings, on the other hand, live only in your head. Which one do you think is more reliable? Wealth in speculation is not built on frequent action. It is built on selective action. The great operators, the ones who lasted, were not the busiest traders. They were the most patient. They waited for conditions that justified risk. They sat on their hands when the market was unclear. And when they did act, they acted with purpose, not impulse. That is the money mindset you must cultivate. Your job is not to trade often. Your job is to trade well. And the first step toward that is learning to distrust the seductive pull of feeling. Because the market has a way of making the wrong move feel urgent and the right move feel dull. If you do not understand that little trick, you will spend years wondering why your confidence so often appears right before a losing trade. Urgency in trading is one of the most dangerous signals a speculator can experience, and yet most men treat it as if it were an invitation. I learned long ago that when the market seems to demand immediate action, it is usually the trader's own emotions doing the shouting, not the opportunity itself. Think about the last time you felt that pressure. The price began to move quickly. Candles stretched. Volume picked up. And suddenly there was that familiar voice in your head. If you don't act now, you'll miss it. Have you noticed how persuasive that voice can be? The market has a clever way of creating emotional tension. Sharp moves attract attention. Attention creates crowd behavior, and crowd behavior creates urgency. But price movement alone is not a reason to trade. It never was. The tape, or the chart, as you read it today, must show structure, confirmation, and proper timing. Without those, urgency is just noise dressed in expensive clothing. Many traders confuse speed with opportunity. They see a fast breakout and assume the smart money must already be involved. Sometimes that is true. Often it is not. Very often, the fast move you are chasing is already mature, already extended, already ripe for a pause or reversal. But urgency blinds the eye. It narrows the trader's focus until all he can see is the fear of missing out. Have you ever bought a breakout that looked perfect in the moment, only to watch it stall the very next candle? That is the emotional trap at work. You see, the professional does not hurry. He observes, he waits, he lets the market prove itself. Urgency belongs to the crowd because the crowd trades feelings. The seasoned operator trades evidence. There is a wide gulf between the two, though it may not seem so in the heat of the moment. One of the first lessons the market teaches, and it teaches it dearly, is that good opportunities rarely require panic. When conditions are truly favorable, the setup is usually clear, orderly and patient. There is room to enter. There is structure to lean on. There is risk that can be defined. Urgency, on the other hand, usually appears when those elements are missing. Study your charts with a cool head, and you will begin to see this pattern repeat. Wide emotional candles often lead to consolidation. Climactic volume often precedes pullbacks. Sudden vertical moves frequently invite late buyers who provide liquidity for earlier, more patient operators. The market is not random in this behavior. It is human nature playing itself out through price. The difficulty, of course, is that knowledge alone does not quiet the emotional impulse. A man may understand perfectly well that he should wait and still feel the pressure to act. That is why trading is not merely a game of analysis. It is a test of self-command. Position size plays a larger role in this than most traders realize. When the size is too large, urgency becomes louder. Every tick feels personal. Every fluctuation feels important. But when the size is reasonable, the mind remains clearer. Decisions improve. Patience becomes possible. Have you ever noticed how much calmer you are when the risk is truly under control? That is no coincidence. The market punishes emotional haste in subtle ways. It rarely destroys the trader in one dramatic blow. Instead, it chips away. A late entry here. A premature exit there. A small loss taken out of frustration. Over time, these small emotional decisions compound into large financial damage. Many accounts are not blown up by one terrible trade. They are worn down by 100 urgent ones. The disciplined trader builds a habit of pause. When urgency appears, he does not automatically obey it. He questions it. He asks what exactly has changed on the chart. Is this movement supported by structure? Is the trend aligned? Is my risk clearly defined? If those answers are not satisfactory, he waits. Waiting is harder than most people think. It feels unproductive. It feels passive. But in speculation, intelligent waiting is often the most profitable action available. The market will always offer another opportunity. It is the impatient trader who behaves as if each move were the last train leaving the station. There is also a psychological trick the market plays. The trades that feel most urgent often occur after a period of boredom. The trader has been watching quietly. Nothing has happened. Then suddenly price explodes. Emotion rushes in to fill the quiet space. The contrast alone makes the move feel more important than it truly is. Recognizing this pattern can save you from many poor decisions. Over time, if you study your own behavior honestly, you will begin to see a personal pattern. Your worst trades will often share a common fingerprint. They felt rushed. They felt emotionally charged. They felt as though action could not wait. That is the moment when discipline must step in. Emotional trades very often begin with one simple fear, the fear of missing out. It is one of the oldest impulses in speculation and one of the most expensive. The market begins to move, the candles stretch, and suddenly the trader feels as though opportunity is slipping through his fingers. That feeling, more than lack of knowledge, has emptied many accounts. I have watched this behavior repeat across generations of traders. The tools change. The charts become more colorful. The platforms become faster. But the human mind remains stubbornly the same. When price runs without us, something inside demands that we chase it. Have you ever felt that uncomfortable pressure when a market takes off without your position? It starts quietly. You were watching the setup earlier. Maybe you hesitated. Maybe the entry did not quite meet your rules. Then price begins to climb. Slowly at first, then faster. Now the mind begins its work. You should have taken it. It's still going. Maybe you're about to miss the whole move. The trader who has not trained his discipline carefully will almost always act at this point. But here is the uncomfortable truth the market teaches: the trade you chase is rarely the trade that pays you well. When a move becomes obvious to everyone, it is often already well underway. Early buyers are sitting comfortably with profit. Late buyers are entering with emotional pressure. That difference matters more than most traders realize, because trading from a position of comfort produces clear thinking. Trading from fear produces mistakes. Look at your charts honestly. How often do extended breakouts pause shortly after the crowd piles in? How often do sharp vertical moves pull back just enough to shake out the impatient? The market has a way of punishing emotional entry points because those entries tend to cluster in the same obvious places. The crowd does not like to feel left behind. And the market, being a reflection of crowd behavior, creates plenty of situations that trigger this fear. The disciplined operator approaches the situation differently. He understands that missing one move is not a tragedy. There will always be another chart, another setup, another opportunity that meets proper conditions. But the emotional trader behaves as though this single move is the only chance he will ever get. That belief alone creates poor decisions. Have you noticed how your standards sometimes shrink when price starts running? A setup that looked questionable 5 minutes ago suddenly appears attractive. A level you would normally wait for begins to feel unnecessary. Risk that once seemed too wide now feels acceptable. Nothing on the chart has truly improved. Only your emotional state has changed. That is the fingerprint of fear of missing out. One of the great ironies in trading is that patience often creates more opportunity than urgency. When you allow extended moves to develop without chasing them, you begin to see secondary entries, pullbacks to structure, consolidations that offer clearer risk. But when you jump at the first emotional impulse, you rarely give yourself the chance to participate under favorable conditions. This is not about avoiding momentum trades altogether. Momentum has its place when supported by proper structure and timing. The danger comes when the decision is driven primarily by emotional discomfort rather than chart evidence. The market can feel the difference, and over time your results will reflect it. Position size again plays its quiet role here. Traders who risk too much per trade feel the sting of missing out more sharply. Every missed move feels like lost money rather than simply another unqualified setup. This emotional amplification pushes them toward chasing behavior. Sensible risk, on the other hand, allows the mind to remain patient. It becomes easier to let trades go when your survival does not depend on catching every move. Wealth in speculation is built by consistency, not by catching every trend. The trader who tries to participate in everything usually ends up mastering nothing. Selectivity is a form of financial strength. It keeps your capital intact for the moments that truly matter. There is also a subtle mental shift that experienced traders develop. Instead of feeling pain when they miss a move, they feel satisfaction when they avoid a poor entry. That is a powerful change in perspective. It means the trader is no longer measuring success by activity, but by quality of decision. You might ask yourself, how many of your losing trades began with the thought, I don't want to miss this? If you review your history carefully, you may find that this single emotion sits quietly behind many costly decisions. Not because the trader lacks intelligence, but because the human brain is wired to chase movement and avoid regret. The market simply exploits that wiring. The solution is not to eliminate emotion entirely. That is neither possible nor necessary. The solution is to build rules and habits that stand firm when emotion rises, clear entry criteria, defined risk levels, pre-planned position sizing. These act as guardrails when the mind begins to drift toward impulsive action. Over time, if you practice this discipline honestly, something interesting happens. The urge to chase begins to weaken. The charts begin to look calmer. Opportunities become easier to evaluate, and the trader slowly shifts from reacting to the market to reading it with patience. Oversized positions have ruined more traders than bad analysis ever did. A man may read the chart correctly, understand the trend, even choose the proper level, and still lose money because the size of his position overwhelmed his judgment. I learned this lesson not from theory, but from the market's expensive tuition. When your position is too large, the market stops being information and starts being emotion. Every tick feels personal. Every small fluctuation begins to matter far more than it should. Have you ever watched a trade with normal size and felt perfectly calm, and then taken a larger position and suddenly found yourself glued to every candle? That change in behavior is not imagination. It is mathematics mixed with human psychology. The larger the position relative to your capital, the narrower your emotional comfort becomes. Your mind stops thinking in probabilities and starts thinking in survival. Instead of asking, is the trend still intact? You begin asking, can I afford one more tick against me? That shift alone is enough to sabotage otherwise sound trades. The market requires room to move. Trends breathe, pullbacks occur, consolidations form. A properly sized position allows you to sit through normal fluctuations without distress. But an oversized position forces you to react to every minor movement, and when you react emotionally, you stop trading the chart and start trading your fear. How many times have you cut a perfectly good trade simply because the position felt too heavy? Most traders do not like to admit it, but the answer is usually more than once. Oversizing creates a chain reaction. First comes tension, then comes premature decision-making. Winners get taken too early because the profit feels too important to risk. Losers get held too long because the loss feels too painful to accept. The trader becomes trapped between hope and fear, and neither one has any place in disciplined speculation. The experienced operator understands that survival comes first. Not excitement, not speed. Survival. Because only the trader who stays solvent long enough can take advantage of the market's larger opportunities. The man who swings too heavily too early rarely lasts long enough to see the bigger moves unfold. There is also a quieter danger that comes with large size, distorted perception. When the risk is too high, the trader begins to see what he wants to see on the chart. A weak level looks stronger. A shaky trend looks more convincing. The mind bends the evidence to justify the emotional exposure. Have you ever found yourself suddenly more confident in a trade after increasing your size? Confidence born from exposure is rarely trustworthy. The proper approach is almost boring in its simplicity. Risk small enough that you can think clearly. Small enough that a normal pullback does not disturb your judgment. Small enough that you can follow your plan without interference from fear. Most traders resist this advice because they are eager for faster gains. But the market has a way of punishing that impatience. Wealth in trading is built through steady compounding, not through emotional position swings. The large fortunes that lasted in speculation were rarely made by constant, oversized bets. They were built by pressing harder only when conditions were clearly favorable, and staying modest when uncertainty was high. Position sizing should always follow the quality of the setup, never the intensity of your feeling. Yet the average trader often does the opposite. When excitement is high, size increases. When confidence drops, size shrinks. This is precisely backward. The market rewards consistency in risk, not emotional scaling. Study your own history carefully. You may notice that your worst decisions cluster around your largest positions. Not because the setup was necessarily poor, but because your emotional tolerance was exceeded. The trade became too important, and when a trade becomes too important, objectivity disappears. Another subtle effect of oversizing is impatience with time. Large positions make traders expect immediate results. If the trade does not move quickly in their favor, discomfort begins to build. But good trades often require time to develop. Consolidations form. Liquidity builds. Trends mature gradually. The trader who demands instant movement is often the trader who exits just before the real move begins. Patience and proper size are close companions in this business. There is a practical rule many seasoned operators quietly follow. If you cannot sleep comfortably with the position on, the size is too large. That simple test has saved many traders from unnecessary stress and costly mistakes. Because the market will always test your emotional limits, you need not volunteer to lower them. The goal is not to avoid risk entirely. Risk is the price of opportunity, but risk must be controlled, measured, and consistent. When position size stays within reasonable bounds, the trader can focus on what truly matters: trend, structure, timing, and capital preservation. And over time, something interesting happens. When size is appropriate, discipline becomes easier. Decision-making becomes calmer. The charts begin to look clearer. The trader stops reacting and starts observing. That shift alone separates many struggling traders from those who quietly build accounts year after year. The disciplined trader learns to question his feelings before he risks his capital. That habit alone separates many survivors from the hopeful crowd. The market does not care how strongly you believe in a trade. It does not reward conviction for its own sake. It rewards alignment with reality. And reality lives on the chart, not in your emotions. Feelings come quickly in this business. Too quickly. A sharp candle appears and the pulse rises. A clean breakout forms and confidence swells. A small loss hits and doubt creeps in. These reactions are natural. They are human. But the disciplined trader treats them as signals to slow down, not speed up. Have you ever noticed how certain trades feel obvious in the moment and questionable in hindsight? That gap between feeling and fact is where most trading mistakes are born. The undisciplined operator moves first and thinks later. The disciplined one pauses. He asks himself a simple but powerful question: what is the chart actually telling me? Not what he hopes, not what he fears, what the evidence shows. This small moment of separation between emotion and action often makes the difference between a planned trade and an impulsive one. You must understand something important. Feelings in trading are not random. They tend to appear strongest at emotionally charged points in the market, near breakouts, near sharp reversals, near areas where the crowd becomes most active. That is precisely why they must be questioned. The moments that feel most compelling are often the moments where risk is least favorable. The chart, on the other hand, speaks quietly. It shows trend direction, support and resistance, consolidation, volume, behavior. These are objective footprints of supply and demand. They do not shout. They simply exist for the trader patient enough to read them. Tell me, when you review your losing trades, How many were taken because the setup was perfectly clear, and how many were taken because the moment felt urgent? Most traders, if honest, will find the answer uncomfortable. Discipline in speculation is not about suppressing emotion entirely. That is neither possible nor desirable. Emotion provides awareness. It tells you when something in the market has changed. But awareness must be followed by analysis, not immediate action. The disciplined trader uses feeling as a prompt to investigate, not a command to execute. There is also the matter of consistency. Questioning your feelings must become a habit, not an occasional effort. Many traders exercise discipline when conditions are calm, but abandon it when volatility rises. That is precisely backwards. The moments of greatest emotional pressure are the moments when rules matter most. One practical way to build this habit is through pre-defined criteria. Before the market opens, the disciplined trader already knows what qualifies as a valid setup: trend alignment, key levels, risk parameters, position size. When these are written clearly, feelings lose much of their power. The trader is no longer deciding in the heat of the moment. He is simply checking whether the conditions are met. Have you written your rules clearly enough that emotion cannot easily bend them? If not, the market will eventually expose the weakness. Another useful observation is how feelings often push traders toward activity. The mind equates motion with progress. Sitting still feels unproductive. But in trading, activity and profitability are very different things. Some of the most profitable periods in a trader's career involve long stretches of waiting, followed by brief moments of precise execution. The emotional trader grows restless during those quiet periods. He begins to look for reasons to act. Small movements start to appear meaningful. Marginal setups begin to look acceptable. All because the discomfort of doing nothing begins to outweigh the discipline of waiting. The professional learns to reverse this relationship. He becomes comfortable with inactivity. He understands that capital preserved is capital ready. He knows that forcing trades to relieve boredom is one of the most reliable ways to damage performance. Over time, questioning your feelings produces a subtle but powerful shift in mindset. Trading becomes less about prediction and more about response. Less about excitement and more about observation. You begin to trust process over impulse. That is where steady wealth building in the markets truly begins, not in dramatic wins, but in the quiet elimination of avoidable mistakes. There is no shortcut to developing this habit. It is built trade by trade, review by review, moment by moment. Each time you feel the urge to act, and choose instead to examine the chart carefully, you strengthen the muscle of discipline. Each time you ignore that urge and suffer the consequences, the market reinforces the lesson in its own expensive way. Consistent wealth in trading does not come from constant participation. It comes from selective participation, a truth the market teaches slowly and often painfully. Most traders begin their journey believing they must always be in the market, always active, always hunting the next move. It feels productive. It feels professional. But more often than not, it is simply expensive. The market does not pay you for effort. It pays you for precision. Think back over your own trading. How many trades were taken because the setup was truly exceptional, and how many were taken because you simply wanted to be involved? If you are honest, you will likely find that activity and profitability rarely move in the same direction. The inexperienced trader fears missing opportunities. He watches the chart and feels uneasy when price moves without him. That discomfort pushes him into marginal trades. Setups that are almost right, nearly convincing, but not quite aligned. Over time, these small compromises accumulate. Not in one dramatic loss, but in a steady erosion of capital. Selective traders operate differently. They understand that the market offers many movements but far fewer high-quality opportunities. Their job is not to capture every swing. Their job is to wait patiently for conditions that clearly justify risk. Have you ever noticed how the best-looking trades on your chart are usually obvious in hindsight, but were passed over in real time because you were busy with something else? That is the cost of overtrading. The market has rhythms, periods of expansion, periods of consolidation, periods of uncertainty. The selective trader studies these conditions carefully. When the market is choppy and directionless, He reduces activity or steps aside entirely. When structure becomes clear and the trend strengthens, he prepares to act. This alignment between participation and market condition is one of the quiet edges professionals develop. Many traders resist this idea because waiting feels uncomfortable, doing nothing feels unproductive. But in speculation, patience is not inactivity, it is preparation. Capital that is not exposed during poor conditions remains available when better opportunities appear. You must remember every trade carries risk. Even good setups fail. If you expose your capital to every marginal opportunity, you increase your chances of unnecessary drawdowns. But when you concentrate your risk on the clearest situations, your capital works more efficiently. Position sizing ties directly into this principle. Traders who participate too frequently often compensate by increasing size when they finally see something they like. This creates emotional imbalance. The better approach is steady, measured risk applied only when conditions are favorable.